Dornbusch download 120. Happy 2017. Lots of numbers in that statement, Dan.
Didn't they? What?
Frightening stuff. And
that's why you're a broker, ain't you?
A used share salesman to you. No, look, we're happy and happy New Year and welcome. And as the doorbell's going off. Interesting start to the year, Dan. Share market put on about 3.5%-4% in December. Any particular reason?
The Trump
bump.
I just wonder, Andrew, whether, we talk about buy the rumour, sell the fact. I wonder whether Trump getting in is sort of like buying the rumour, and when he gets the keys to the nukes, whether that'll then be sell the fact.
And in fact, it's funny you should say that because, we've been saying that to clients, well, pretty much since he got in, saying, look, it's all happy days, but come Inauguration Day, which is the 20th of January or 21st for us, it starts becoming a bit more of a dangerous time because even if you take Trump out of it, and I realise you can't, but for the sake of history, that last 2 weeks of January is confession season. So if companies are going to come out with a shocking result in February, which is profit reporting season, you'd expect them to be sort of putting their hand up next 2 weeks.
Yeah.
So between Trump getting in and confession season leading into profit reporting season, it's a dangerous time, and I think that's why we've seen the share market over the last couple of days lose about 100 points.
Yeah.
So how are you playing this? Are you just sitting back and waiting? Or?
Pretty much waiting, Andrew. The other thing too that's sort of at the back of my mind is, will Trump try and talk down the US dollar as well? He's going to do a few things, isn't he? If he cuts corporate tax rates, he's going to have to sort of, that'll be positive over there. That'll bring more money back in. That'll push up interest rates as well.
Plus all of his spending, freeways, armies, walls, good luck with that. It's all very fiscally stimulatory.
Yes.
And it's a real compare and contrast to the last 20 years, which has just been using the blunt stick of interest rates. And I think that's now on the outer. But you're right, interest rates in the US are going to go up and pretty aggressively next year, which should support the US dollar. But then you've got, as you're saying, Trump is, and he's already started on Twitter because that's how he communicates with the peoples, through Twitter. Pushing it down. You can't argue
with Twitter, can you?
140 characters.
You're a liar, Twitter.
They've surely got to take the phone off him, like seriously. But in all seriousness, it's going to be really interesting what happens with him post the election. So I think that vindicates what you're saying. Sit back, watch. Anything, though, in particular that has been sort of catching your eye?
Not really. I'm really starting to look more at those exchange-traded funds, Andrew. A lot of our client base is income really require the income stream. And, those better shares who we had the seminar with, they're starting to really look positive in that regard. The yields there are good. Some of those listed investment companies, those yields are looking up as well.
So there's like Harvest, HVST.
Yeah, that's the monthly one.
There's WIMAX, which is the quarterly one.
Yep.
So they're sort of the two exchange-traded funds that have more of an income view.
ANZ have one in there that invests in the ASX 300 as well. Not as good a dividend payer as either of the better shares ones, but it's still pretty good. So a bit of diversification in there.
And Brendan will have the chart in there for that one in the moment.
It's like ZYAU or something.
Something really easy to remember. And then in the LIC space, and we could probably spend another Dornbusch download talking about the differences between LICs and ETFs.
Probably should.
But anything in the LIC space catching your eye from a dividend point of view? Like Degera, to me, is probably the natural one, DJW Investments, and they'd be getting close to being come dividend.
Yeah.
But you're
sort of looking at that Henry Morgan.
HWL?
HML. Yeah. It's really out there, though. Most of our listed investment companies actually hold the asset, don't they? Henry Morgan will buy oil futures and currency futures and those sort of things. So it's very, very volatile. But he's spoke about a 20-cent per share dividend, which is about a 13% yield on its current value, and franking on top of that. So,
but like you're saying, it's using derivatives or synthetics to achieve that. So even though they're having a great run, happy days. He picks a couple of the wrong ones. Lots of tears.
Exactly right. But reading his stuff, he really hangs his hats on stop losses as well.
Okay,
so
he's pretty aggressive.
They're putting support. The big thing in my mind is what's the main asset? And the main asset's cash. Cash can easily go into the bag and off it goes. So it's it's not something you'd put the whole house on.
So I will keep it a short, sharp one for this week, but I think the word is caution at the moment. Technically, the market had to hold 5,700, which is broken this morning.
Yep.
I think about 5,500 is now the next level of support. So, back at 5,500, we're probably starting to get more interested, certainly those income-paying shares. Even like Bendigo, Bendigo's dropped 4% today. It's on about a 5.5% fully franked dividend.
Good again.
So there's a few of these that have run pretty hard over December, January with the Trump bump starting to come off. So next week we might talk a little bit more about that, and we'll also, because Heather will remind us, to talk about ETFs versus LICs as well.
No worries.
Till next week.
Cheers.